Everyone seems to be saying the exact same thing about crypto. It's the future of finance, a decentralized utopia where anyone can buy in, hold on, and eventually ride a rocket ship to $1 million. But the statistical reality tells a different story. The overwhelming majority of retail investors who enter the cryptocurrency market lose money. A sophisticated wealth extraction machine now sits on top of the original decentralized vision. It functions to harvest capital from uninformed retail investors before they even understand what hit them. To survive this market, you have to let go of the fantasy of easy money and look closely at the mechanical gears running this hostile financial environment. The outermost layer of this machine is the altcoin market. While thousands of these alternative tokens promise to overhaul global industries, they function primarily as a speculative casino. The mechanics here are straightforward. Creators mint new tokens out of thin air, then pay influencers to generate hype across social media, driving up the perceived value of an asset that lacks any underlying utility. Once enough capital flows into the project, the creators suddenly abandon it. They pull the liquidity, shut down the website, and walk away with the funds in a move known as a rug pull. The average investor provides the cash that allows these insiders to exit. In financial terms, retail buyers are the liquidity that makes the creators' profits possible. Treating these alternative tokens as long-term investments ignores their structural design. They exist to attract emotional capital for immediate extraction. Navigating this space requires separating Bitcoin from that predatory altcoin market. Bitcoin has no CEO, it has no revenue, and no marketing department. Its value is derived from a hard cap of 21 million coins and the durable market belief that this scarcity makes it valuable. This chart shows the mechanical engine driving cryptocurrency prices. A timeline tracks the 21 million fixed supply limit across 4-year intervals. At these marks, the network cuts the miner reward in half, reducing new supply and creating a shock that forces the price upward. This predictable schedule of boom and bust is hard-coded into the network. These cycles of extreme drawdowns and recoveries are the direct result of these mathematical supply shocks. Institutional insiders position themselves based on this 4-year math. They use the predictability of the cycle to profit from the emotional instincts of the average retail investor. This chart maps the trap during a bear market. While prices are low, institutions quietly accumulate, while retail investors panic and sell at the bottom. After media headlines announce new highs, retail floods back in, buying the peak and allowing smart money to exit. This pattern of accumulating at the bottom and selling at the peak is how insiders profit. Retail investors facilitate this transfer of wealth by getting the timing of the cycle backward. Navigating this hostile environment requires a strict defensive toolkit for 2025 and beyond. Rule 1. Mentally isolate Bitcoin from the rest of the market. Its scarcity gives it a unique risk profile that altcoins simply do not share. Rule 2. Set a hard limit on your financial risk. Never allocate capital to this ecosystem that you cannot afford to lose entirely. Rule 3. Utilize dollar-cost averaging exclusively during periods of extreme market fear. Buying when media attention is low has historically produced better results than buying during peak euphoria. Rule 4. Eliminate third-party risk through cold storage. Relying on exchanges for custody makes you vulnerable to hacks and platform collapses. And Rule 5. Ignore the daily price action. This volatility is designed to trigger emotional decisions, which are almost always expensive ones. Successful investing in this piece is less about picking winners and more about systematically neutralizing the traps designed to steal your capital. Cryptocurrency is a high-risk, high-volatility asset class. To navigate it, you must move through an ecosystem filled with bad actors, misaligned incentives, and predatory marketing. The winners in this space are those who understand the mechanics of the machine, secure their own assets, and have the psychological fortitude to do nothing while everyone around them is either euphoric or terrified.